Good day, ladies and gentlemen. This is Barry Norman on behalf of Investors Trading Academy. That's www.investortradingacademy, all one word.com. You can go there and look at all of our other classes and sign up for one of our upcoming classes. Our webinars are very inexpensive, and you can also sign up for one-on-one training, personal consultation, or just watch our videos online. But here we go. Welcome to our class on understanding IPOs. Now, everybody sits back and says, how can I benefit by IPOs? All the rich people make money. All the big brokers make money. All the bankers make money. You see Goldman Sachs jumping in on Facebook. You see, JP Morgan Chase getting in on Snap. You see all these things, but you have no idea how you can benefit or exactly understand what an IPO is. And understanding what leads up to an IPO can get you ready to find ways that you can trade and successfully make money. Just recently, the head of the New York Stock Exchange in the U.S. said they wanted to find ways to open IPOs to a wider range of investors and get it down to retail investors who are locked out of this market most of the time. But we'll talk about two ways that you can capitalize from IPOs towards the end of this class. Now, again, today's class is brought to you by www.investorstradingacademy.com. I'm the director, so stop by and visit us sometime. But understanding what an IPO is very important. Okay, and it stands for, as most of us know, initial public offering. Now, IPOs take place all over the world. I mean, the biggest ones happen primarily in the U.S. because it's the biggest stock exchange in the world. And most people want to be listed with either the New York Stock Exchange or the NASDAQ. Because choosing where you are listed is as important as everything else involved in your company. It is a big choice that CEOs, CFOs, and board of directors have to make before they take their company public. Not only do they have to decide where they want to take it public, they decide how much money it's going to cost. There's months and months and months of preparation involved in getting ready for an IPO. Most things that you won't even see if you are not even aware of. But as you can see in our little screenshot here, you can see all the steps involved in, or what decisions have to be made in starting an IPO. Now, you might ask why? Because going public is a monumental decision for any company. It forever changes how a company goes about doing business. And, it's one thing when you hear about Facebook or Snap or, some of the big companies, but there are many, many, many IPOs that never make the headlines. You don't ever hear about. And a lot of times they're not even successful, or they are successful, but the change in the business becomes so expensive, so cumbersome, or the company doesn't do as well as expected, and the load of legalities on that company end up draining that company. So there are many more than these big headline events that you see happening. A public company has access to more and often deeper sources of capital than a private company. The actual process of going public can be time-consuming and present certain unique challenges that a company should prepare to undertake. The initial decisions and initial public offering is a transformational event for an organization. The preparation for being public is just as important as the preparation for going public. A company will need to meet additional requirements and continuing obligations, such as public company, that may require new skill sets, additional resources, and changes to the business model. Okay, a lot of times, company executives who have led this company to the point where it's large enough to go public will have to be moved out of their jobs, because the public and going public expects a certain level of upper management. They expect certain resumes. They expect certain levels. They're looking for, because all you're looking for when it goes public is pieces of paper. And a lot of times, the CEO of a company, even though he's done a very good job running that company, will not be attractive in a public company. And so forth. So before they go public, they have to even look at these changes. Thinking through these requirements in advance and developing an appropriate plan is key to a successful entry into life in the public as a public company, and will reduce unexpected post-IPO issues. And you get a lot of these, especially in those smaller companies. Now, what does going public mean? It's a process of offering securities, generally common stock, of a privately owned company for sale to the general public. The first time these securities are offered is referred to as an initial public offering, or IPO. From then on, after that initial rollout, it's just a stock trading on an exchange. So there are many advantages to a company going IPO. The biggest one is financial. So an IPO in which a company sells its unissued securities and receives all the proceeds in the form of additional capital is called a primary offering. A security sale in which securities held by the owners of the company are sold and from which the owners receive the proceeds is called a secondary offering. This is why, again, you hear in the news that Mark Zuckerberg became a billionaire on paper, but he didn't actually get money in his pocket because he wasn't selling his shares. And a lot of times they're locked into when they can sell their shares. Sometimes it's 180 days after public offering. So when you have an IPO, you're not buying shares from the present owner. So say a hypothetical company, when it set itself up as a corporation, issued 1 million shares, and the two owners are holding 500,000 of those shares. Those 500,000 shares are half of the company. But when it goes to IPO, it's the other 500,000 that are being sold. Now, of course, the price of that IPO values the shares that they hold. Okay. IPOs are almost always primary offerings, but may include the sale of shares held by present owners, but it must be disclosed. What most important questions a CEO should ask is, why do I want to go public? The reasons include to access capital markets to raise money for expansion of operations, to acquire other companies with publicly traded stock as a currency, to attract and retain talented employees. And this is very important because a lot of times employees are given shares or options or stocks in a company. Okay. So it's a very good way to offer them when for each year of service, they start getting so many shares or building up and they have to be there for so many years in order to exercise those options. So it's a nice way to pay out something without paying cash. To diversify and reduce investors' holdings, to provide liquidity for shareholders, to enhance the company's reputation. Other reasons may be private and personal. It is important to keep specific goals in mind throughout the going public process. Now, a tip, during the IPO process, companies often underestimate the requirement to complete the transaction in addition to the ongoing obligations and scrutiny of life as a public company. An early assessment of a company preparing to go public could uncover unforeseen things like financial reporting, taxes, governance, internal controls, compliance, human resources, and structuring. The cost and the amount of groundwork having to be done before going public can be exhausting on a company. Now, so a CEO has to ask himself, has your company reached a point at which prospects for maintaining a strong sales and earnings growth trend in the future are reasonably good? Many companies that have successfully gone public have illustrated market support for their products or services that would sustain an increasing annual growth rate over a period of time. The established company can answer this question with historical sales data, while the early stage company must market research projections and demonstrate product superiority. An early stage company may qualify as an IPO candidate due to the uniqueness or its product or service. Now, the other question we have to look at is leadership capable and committed? In any public offering, the quality of the leadership team is a key factor. It is vital to ensure that the board of directors as well as the management has the right blend of experience and skill to establish the optimal corporate guidance structure and ensure that the board committees are operating effectively. Now, once you've gone past that loop, you have to do the most important thing you can do, and that's choosing the stock market you want to trade on. Each stock market has specific entry requirements, such as earnings history, shareholders' equity, market capitalization, number of expected shareholders, and corporate governance. Okay. They also have a lot of fees tied to them. Okay. Like the NASDAQ is more reasonable than going to the New York Stock Exchange. A company seeking to go public must choose the market that is right for its stock. A company's banking advisors can furnish in-depth information on this investor base. But if, for instance, tech stocks seem to go to NASDAQ, if you want to be a banking stock, a financial stock, you tend to go to the New York Stock Exchange. It's just historic. It's the reputations of the exchange and where the sectors are known to trade. A company and its advisors should approach the stock market early in the capital raising process to ensure the smoothest possible transaction. As the economy continues to become more global, companies considering overseas or dual listings will also need to evaluate the impact of IFRS on the offering process. That's to go have foreign regulations. Hot markets accept many offerings, but companies do not want a deal that is just one day too late. Recognizing the urgency of a registration process is critical. Even in a slower market environment, there is what is considered as an industry pop or industry flurry. Like when you see all the high-tech companies going and having these successful IPO, you see more and more coming because as the industry is hot, or a couple of years ago, you saw lots of environmentally friendly companies or green companies, and they were popping like crazy. Sometimes, you just see different things popping, and when that industry, that market's hot, these CEOs or these board of directors run. If they were thinking about eventually going public, they will run when that market is hot. So like, for instance, right now, retail sales are terrible. So you don't see any retail companies coming to the public market. Okay. So IPOs may be perceived as a Me Too company and not as strong as a leader. And when interest wanes, the window of opportunity closes quickly. However, industry pops give the public investor good current information on comparable companies in order to make valid pricing decisions. Market conditions will also impact the valuation of a company and the eventual pricing of its stock. So there are other alternatives that one can use, okay, as opposed to going public. So when a company decides this, they've already evaluated all the other possibilities. And taking a company to IPO is never a bad thing. Taking a prepared company and having a successful IPO is very, very important. A successful IPO requires careful planning. This requires two main tactics. First, the company must prepare its management team, and business units begin acting like and functioning as a public company, both internally and externally. Second, a company must identify the key players in its going public team, from the experts it will hire to the staff members who will help prepare registration and other sales documents. The decision to go public can be one of the most important in a company's history. Now, once we start commencing the sales effort, you can't turn back. Now, you can't offer any securities or instruments for anybody to sell until the day you go public. You can't collect money. You can't give any guarantees. So no offering of securities, either oral or in writing, is permitted before the registration statement is initially filed with the SEC. These rules are very strict, and a company must be careful not to generate undue publicity about itself that could be construed as an attempt to stimulate interest in its securities. Now, once they've filed their initial public offering, then they can start talking, and you'll be surprised, we'll talk about in a minute, how much media hype these companies put out there. After the initial filing, however, and concurrent with the preparation of the amended registration statement, SEC regulations do permit certain types of promotional activities within the brokerage community, such as noted below. And what they'll do is they'll put out what's called a prospectus known as a red herring. It's to attract, not you and me, it's not designed for retail investors. It is designed to create market talk. It's to get brokers to talk it up, to get bankers, to get investment houses to start thinking about buying in or buying shares or selling it out to their traders at an earlier date. They try to start creating the hoopla. They do this with what's called a red herring because it isn't real data. Okay. Prior to the implementation of EDGAR, which is one of the regulations in the U.S., this language was required to be printed in red ink, hence the name red herring. And it was information contained herein is subject to completion and amendment. A registration statement relating to these securities has been filed with the SEC. These securities may not be sold nor may be offered to buy, be accepted prior to the time of the registration statement becomes effective. This perspective shall not construe any offer to sell or solicit of any offer to buy. Then what they do is once that's all ready and out there, they actually start road shows. They start going out door to door. They're not flying in, in a plane for a meeting, and going, say, in a raggedy hotel. They're having, this is a big investment banker who's being flown out first class because they're trying to pump this up for potential investors to learn about the company. An underwriter will arrange meetings called road shows with financial analysts, brokers, and potential institutional investors. Okay. This is what you started to see all before the recent Snapchat IPO. Okay. This is to get the hoopla out there. This is to get the hooray, the parade started, and it starts intensifying as it gets closer. The roadshow represents a critical part of a company's selling efforts, since it is here that a management team promotes interest in the offering with the institutional investors. This can be a very grueling process since the span of time can last up to 2 weeks with a number of presentations a day. Because remember, you want this all to roll out with a big band parade, because the big parade gets you and me to start buying that stock the minute it is listed on the exchange, which pushes the price up, because nobody can guarantee what the price is until it hits that exchange. And then all of those initial orders are fulfilled, and then we start buying. Well, they want to see that price driven up from the price they bought, not the price coming down. By the time the registration statement has been filed, a company and its underwriter have generally agreed on the securities, both in number of shares and dollar amount to be sold. However, the final price at which they offer the securities to the public, the exact amount of the underwriter's discount, and the net proceeds to the registrants have not yet been determined. The negotiation and final determination of these amounts depends on the number of factors, including the past and present performance of a company, current conditions in the security market, and indications of interest received during the roadshow. Now, for example, in establishing an offering price, the underwriter will look at a multiple of earnings and cash flow based upon the experience by similar companies. These multiples may be applied to the company's most recent operations. Now, there is a closing date. The closing date generally specified in the underwriting agreement is usually within 3 to 5 days after the pricing of the offer. At closing, a company delivers the registered securities to the underwriter and receives payment for the issue. Various documents, including the bring down letter prepared by the independent accountant, are also exchanged, because now the underwriter actually has those shares. So he's hoping that the price goes up and he can sell them as they're going up because he bought them at a discounted rate. And now the underwriter is actually who is selling them to the public. So an IPO gives the investing public an opportunity to own and participate in the growth of a formerly private company. By their nature, however, IPOs can be risky and speculative investments. There are 2 ways the general public can invest in new public companies like you and I. First, if you are a client of an underwriter involved in an IPO, you may be offered the opportunity to directly participate in the IPO. So hence, it is smart sometimes to have a nice brokerage account with the big banking facilities, with JP Morgan, even if you're not trading with them, even if you don't have your money, to open up a $50,000 or $100,000 account, because it might get you this invitation to be part if they're involved in the underwriting process. Now, we have a big one coming up. We don't know exactly when, but Amoco, the Saudi Arabian gas company, and it's going to be generating speculation all over the place. Okay. In this instance, you will be able to purchase the shares at the offering price. It is often the case that underwriters and dealers with will distribute most of the shares in the IPO to their institutional and high net worth clients, such as mutual funds, hedge funds, pension funds, insurance companies, and high net worth individuals. For a typical investor, being able to directly buy a popular IPO is a unique opportunity. Hence, you can just simply position yourself to get offers to do this. And with the push by the New York Stock Exchange and by the SEC to open these up to a larger crowd of people, having these accounts might be worth, again, just putting part of your retirement fund, not trading with them, not necessarily even investing, just having your cash in an open account might get you the invitation. Second way is the other way, which is more common in the case of individual investors, is to purchase the shares when they are resold in the public market in the days following the IPO. An investor could place an order with his or her broker to purchase shares in this manner. So you can pre-order, but you don't know exactly what price that first day will settle at or where the broker can actually enter that. So you might miss the market by putting a price too low or miss some profit by placing a share price too high. Now, this is for the big boys. This is for the ones that are all over the press, but there are but there are a lot of IPOs. And hence, you have lots of investment opportunities because you don't have to invest in just Snap or Facebook to make money. A company undertaking an IPO disclose required information in a registration statement, typically on a Form S1. Form S1 and its amendments, which are denoted as S1A, are filed with the SEC and publicly available through the SEC's EDGAR database at www.sec.gov/EDGAR. You can go search for them easily through the SEC. You can then see everybody who has filed one of these. You can see then all of these small companies that aren't getting the hype and the hoopla that are coming to the public, and it's easier to get involved in these. Now, comment letters issued by staff during the course of the IPO filing reviews are also made available on EDGAR, but they are not posted until at least 20 days after the registration statement is declared effective. So being well informed is critical in deciding whether to invest. Therefore, it is important to review the prospectus and ask questions with regards of an IPO. Whenever possible, verifying the information you are given against independent sources is also recommended. If you buy directly in an IPO, you will receive a copy of the prospectus before your broker confirms your sale. But you can also read the prospectus before then by reviewing the prospectus included with the company's most recent registration form on the SEC's website. When you read the prospectus, you should check to make sure you're referring to the company's most recent filing, because the contents of the prospectus may be revised during the course of the registration process. Hence, you want to have something newer than the red herring. In addition to reading the prospectus, be sure to ask questions if the information is not clear. What else should you consider? Following are some things to consider when making an investment decision involving the shares of a new company. The offering price. Okay. It's important to understand what is and is it a good offering price? Is it priced too high for the market? Do you think it possibly will decline in the first few trading days and you can buy it lower in public sale? Okay. Remember, these small companies have limited trading volume. That means less liquidity. So even though the stock might pop, okay, you might not be able to sell it because there just isn't enough available. And because of lockup agreements, there might be a period of 180 days where there's just not enough liquidity in the markets. Now, the other thing you have to watch for, which Snap was a perfect example, is dual class common stock. It's becoming more popular, which never used to be offered, where they have a secondary class of public stock that's being offered as the IPO, which inhibits or reduces or may not offer any voting shares or any control of the company. And so you want to watch and make sure when you're looking at prices that you're matching apples to apples. So more investors should be able to buy stakes in closely held startups, said acting SEC chief. The chief says the Securities and Exchange Commission should allow more investors to buy stakes in closely held startups such as Uber Technologies, Airbnb, Life, the agency's chairman said recently. Michael Pinawar, the SEC's acting head, said the commission should consider altering restrictions that lock out investors with only moderate wealth. He said the standards which limit such private deals only to well-heeled accredited investors do not serve their intended purpose of protecting those people from the potential risk of putting money into higher risk investments. Currently, only individuals who meet certain wealth or income standards are allowed to invest in private stock offerings that are outside of public marketed companies. They range from stakes in startups to hedge fund offerings. So we're going to start to see more and more availability of these to the general public. So you should get ready, because IPOs could start being a whole new successful way of trading. And like I said, if you have a nice retirement fund that you manage, if you can park some money with a brokerage, have several brokerage accounts, okay, so that you might get invited to their IPO. So look for the biggest private investors, the big underwriting companies that work with the big banks, and open an account with them so that you can get, if this is one of your goals, so you can be invited, or you will be invited to take part in anything that they're underwriting or taking part in. So thank you very much for joining us today, and go to www.investortradingacademy.com to see more of our classes, or sign up for classes, or enroll in one-on-one training. Thank you very much.